Welcome to a new Smart Money video on financial education, the basics. This is really the 101. What are the basics of financial education? What do you need to know in order to start managing your money better? We're going to look at budgeting, the effect of interest, saving, and also the credit debt cycle. If you enjoy videos about finance, personal growth, and business, please consider subscribing to the channel. The first topic is budgeting, and this is about measuring everything that comes in and goes out. Most of us know that, but it's not just about measuring what comes in and what goes out. It is also about setting up financial goals, and this is really important. If budgeting is only about making sure you don't overspend, and it is not about goals, it is something that's boring, that's unattractive, and honestly, who wants to do it? But if you put goals into your budget, it makes it come alive. It makes it something to achieve. It makes it something worthwhile doing. And in terms of goals, the best way to set goals for budgeting is to do them in a smart way. Okay, so let's do an example of a smart goal. And that is about saving up for a deposit for a house that you want to buy. Now, to make it fit into the SMART framework, the first thing it needs to be is specific. So it is about saving the deposit. So that's quite specific. The next thing it needs to be is measurable. So now it's not just about saving a deposit, it's about saving a specific measurable amount of money. So let's say 50,000. So now my goal becomes, I want to save up 50,000 for a deposit on a house. The next thing is that it must be achievable. And if you look at it, 50,000, and say you're able to save $500 a month, that means it's going to take you 100 months to save up that deposit. That's not really achievable. If that's the case, and you've broken your goal up, and this is the whole point of the process, when you're looking and using the SMART framework, you apply each step to it. So now we get to step number 3, and is it achievable? 100 months. That is achievable, but I'm guessing that's too long. That's about 8 years and some change into the future. So that's too long out in the future. That's not going to be helpful. It's better to say, okay, let me save as much as I can, and you figure that out, and let me work on increasing the amount of money I can save. That's a better goal in this case. Let me increase the amount of money I can save each month. Maybe you do that by reducing expenses, or maybe you do that by increasing your earnings, by finding another job, or by increasing your business activities and such. So let's say you can save $1,000 a month instead of $500. So then it is going to take 50 months or just under 5 years to save up for your deposit. So okay, that seems achievable. Now you want to make it relevant, and you want to ensure that it's relevant. Now it's sitting within your budget, and a budget is all about tracking what's going out and what's coming in and ensuring that you are not overspending. So is that relevant? Yes, this goal is very relevant. So tick, it passes that particular checkpoint in the SMART framework. Now the last one is T, time bound. And so we know, if we work it out, that you want to achieve this within 4 to 5 years. You've put a time around it. Perhaps you want to encourage yourself and stretch yourself towards a goal. So you say, I actually want to achieve this in 3 years. So you're believing that you can find more money to put away, and more money you can save in your budget than just the original 1,000, and therefore you'll achieve this goal in 3 years. Now you have a SMART goal orientated towards your budget. We're going to look at the next thing now, which is interest rates. The first thing with interest rates is to ask the question, why? Why do companies charge interest? Well, it is for 2 reasons. One, there is a risk premium. In other words, they're lending money, and they know that not everybody they lend money to is going to pay back. So part of that interest rate is to insure against people who don't pay them back. And the second thing is, well, they want to be paid for that. You know, if I give someone $1,000 and it's not a gift and I lend it to them, I want to get something back for that asset. It's a passive income stream. And I created a video on passive income streams. If you want to check that out, I'll drop a link in the description for it. But the important thing here is that interest is charged and you need to pay it back. Now, there is something critical with interest, and that is called the compounding effect. The compound effect of interest can work for you or against you. Some have said it is the most powerful force in the financial world today, and that is compound interest. Let me do an example for you. So if you have $10,000 and 6% interest, it would take you just under 12 years to double your money. So you do nothing. You take $10,000 and you put it in a savings account or some sort of investment account where you get a 6% return per annum. It's compounded each month. You will have in under 12 years another 10,000. So your total balance in that account will be 20,000. Here's how interest can work against you. If you take something like a credit card where interest rates are much higher, say 21%, it now only takes less than 4 years for that to double. And this is the problem with credit card interest. This is the problem with any high bearing interest loan. It works against you so fast that before you know it, you owe double the amount. So the critical thing here is that you flip it on its head. You get out of these high interest bearing debts as fast and as soon as you can, and you ensure that you make compound interest work for you. And this is really an important step in financial education. It's one of those things that once you get it and you get it working for you, it is really fantastic for creating wealth. If you're enjoying this video, please remember to hit the like button and subscribe to the channel. So we're going to look at savings and deposits now. Now savings is whenever you put money aside and you take a certain account and you deposit money in. So when you put money into an account, that's called a deposit. Or when you save up a certain amount of money for a mortgage, they want some money down first, and that's a deposit as well. So the key here is that it's a set amount of money being put into account that's deposited into that account. Now, most of us have some sort of check account. You get no interest and no benefit from having a lot of money sitting in a check account. You certainly don't want to go into overdraft. Often the interest on overdrafts is very high, and you also pay an overdraft fee. So that is a waste of money. So you want to be careful not to use an overdraft and not to incur those fees. However, that doesn't mean you put all your money in your check account. And there's two reasons for that. Number one, if all of your money that you're saving is in your check account, you struggle to see how the balance is increasing, because if you log on at different times of the month, that balance is going to be coming down. And then after you've been paid, that balance will go up. So it's kind of hard to track how much savings do I actually have. So that is the first thing. It is difficult to track. If you have a separate savings account, which is often free from your bank, you're able to put money in there. And when each month comes around, you put money in, and so you can see that balance grow. At any time of the month, because expenses aren't coming in and out, and different transactions aren't happening on your savings account, that happens on your check account, that means that you are able to see exactly what your balance is and understand how you are progressing on your goals. The second reason is if any fraud or such transaction takes place on your bank account, it often takes place on your transactional account, your check account, which means that if you were to make a mistake and somehow expose those details and someone was to get to those details, they can only take the amount of money that is in that account. So keep the two separate. It provides some protection, not total protection, but some protection, and also helps you to track your balances, which is really helpful. And the final thing we're going to look at now is the credit debt cycle. And this is really important for our financial education because it is actually a human psychology and behavioral problem more than a financial education one. The concept is fairly simple. When you are saving money and you have a positive balance, you get interest and you're able to buy things. However, you are also able to get credit, which means you can buy things that you don't have the money for. The problem with this is that most people fall prey to seeing credit as their own money. And so what happens psychologically is if you want to buy, say, that games console for $500, then you see that and you don't have the money and you have no credit. You can't buy it. There's nothing you can do. You just can't buy it. If you have a credit card that has a facility of, say, $1,000 on it, you're now able to look at that and say, I have $1,000. And I'm able to spend it and buy that console. You see, the problem is your mind tricks you. You don't actually have that $1,000, but when you see the number on the statement or within the app, you think you have that money. You don't, but it looks like you do. Your name is on the account and it says amount available 1,000. Now, logically, when we think this through and we rationalize it, all of us know that's not our money, that's just the credit limit that's been extended to us. However, our minds trick us and we somehow start to take ownership of it. Look, the credit card companies also market and communicate in such a way that it feels like it's our money. And then we spend it. That's where the cycle starts. We get into debt. And now we owe money to the credit card company. And then there's a negative emotion that we feel. And we feel like, wow, I need to get out of debt. And so we spend some time and we focus and we pay down this debt. But once that debt is sufficiently paid down and we see the actual amount we owe versus the available balance, we start to look around and find more things that we want to buy. We then buy it and increase the amount that we owe, and so the cycle starts again. And so the cycle is that we buy stuff on credit, we pay it down, we buy more stuff on credit, we pay it down. And we're only ever catching up. We're never getting ahead. And that is the credit debt cycle. Now, how do you break that? And the chief way of how you break this is, what do you associate with success? Do you associate being debt-free as successful? Or do you associate having the latest car as being successful? Do you associate freedom with success? Or do you associate goods, material things, a big house with success? Because whatever you define as success, whatever you fix your mind to and that is your goal, officially or unofficially, that is what's going to orchestrate and command your life. And so the important thing here is, if you want to break the credit debt cycle, you need to shift your view from material things representing success to other things such as peace or freedom or being debt free or good relationships, all of which cost no money. And that's how you break the cycle, because it's now your chief goal in life are these things as opposed to material goods or the acquisition of them. And that's how you break the cycle. You got to take it back to what you believe and how you look at the world, and that way you can get free. So I hope that this video has been informative today on financial education. This is the first in a many-part series, and we will continue on exploring different concepts and topics. Please do remember to subscribe to the channel if you have enjoyed this video and if you like this type of content. And lastly, I ask if you can share this video with someone else, because together we can create an abundance.